All right. Good morning, everybody. Good morning, everyone, and happy Tuesday. Today's January 30th, 2024. The top story this morning, well, in my opinion, it's UPS earnings because they were just terrible. And UPS used to be one of those companies that was a bellwether for the economy. You know, back before everybody would just scream .com. I'm sorry, I meant AI. Back before everybody would just scream AI, UPS was a good bellwether for the economy. Are people buying things? Are people shipping things? And are people making things? And are those factories hiring people? It was a great way. Our packages moving was a great way to just gauge the health of the overall economy. And if we were to use that test today, the overall economy is terrible. UPS reported today package volume in the United States down 7.4% over the last year. And guys, there's no inflation adjustment in there. There's no EBITDA. There's no adjusted earnings, or, you know, we don't use GAAP principle. We are just talking about how many boxes were moved from A to B last year versus the year before. And it was way down, high single digits, 7.4% lower. And that is inflation, guys. Inflation outpaced wages. Life got more expensive and people bought less stuff. It really is that simple. You can take away all the complex math and the money moving around between Fed accounts and all the issuance and Treasury buybacks and all that complex garbage. If at the end of the day, if people ain't buying stuff, the economy's going to tank. People ain't buying stuff. It's that simple. Global numbers, even worse. Global package volume down 8.3%. So the U.S. just happens to be the cleanest dirty shirt in the laundry. I guess we got that going for us. But package volume worldwide way down last year. We saw the same thing with the ocean carriers. Oceanic freight rates were way, way down last year. The Red Sea came along at just the right time for those companies. It was basically a bailout for them because shipping rates exploded higher when everybody had to take the long way around Africa. So UPS, very bad sign for the health of the U.S. and global economies. But stocks were rocketing higher yesterday, especially late yesterday, because of Aunt Janet's debt plans. Janet Yellen over at the Treasury Department released the quarterly refunding announcement yesterday. How much new debt the government plans to take on in the next quarter. And everybody was cheering because the government is only, laughably, the government is only planning to borrow $760 billion over the next 3 months. And it's hard to imagine someone using the phrase only $760 billion, but there it is. The estimates previously, the market thought Yellen would announce plans to borrow $816 billion. Now it's down to $760. So the market had priced in more bond issuance than we're actually going to get, or at least than they're telling us they're going to make. And so that means the market needs to adjust for less bond supply, which is less downward pressure on prices. And so bond prices started to rally, driving interest rates lower. The stock market just loves lower interest rates. And so stocks rallied along with everything else. So Yellen really juiced the market yesterday, planning to borrow $760 billion versus $816 expected. They also announced there was something in there. They said they're assuming a Treasury general account balance of $750 billion at the end of the quarter. Now, that's interesting because there's $799 billion in the TGA right now as of their latest reading. So are they telling us what I've been theorizing they will do this year? As the reverse repo runs out, they're going to start spending down the money in the Treasury general account to limit bond issuance in order to juice markets higher during an election year. It looks like that is the plan they're carrying out right now. They're also planning to borrow $202 billion in the next quarter after that. Now, that number is supposed to be very low because that is when taxes are due. In this, in the second quarter, the government usually sees a huge amount of revenue during that time, so less need to borrow during that specific quarter. But the government's going to borrow $1 trillion in the first 6 months of this year, and everybody's celebrating, and I'm just over here like, WTF, another trillion in debt. Great. Throw that one on the pile, light up cigars. Everybody, let's celebrate. What's the worst thing that could happen? Don't answer that. Also, GM earnings were out today, and the market thinks they're good. I don't think they're very good. I was looking for the good news. Their guidance was a little strong, a little better than the market was expecting. But some of the numbers in GM's earnings today were really terrible, especially some of the numbers coming out of China and their North American sales figures. And of course, everybody is just having to throw out their EV plans because we're starting to learn that electric vehicles, this big build out in electric vehicles, is what I have been saying all along. It's really just a cash grab for government subsidies, and they don't even care if they actually sell any cars. Well, now those subsidies are about to start drying up. They've spent a lot of the money on the factory build outs, and they're realizing, well, crap, people aren't buying these things as fast as we had hoped, even though we just built giant factories able to produce them. And so they're all having to cut back their expectations of electric vehicle production, even as they're building out more and more electric vehicle capacity, not in hopes of selling cars, just in hopes of getting your tax money through subsidies for the CHIPS Act and the Inflation Reduction Act. So a lot of talk about EVs and GM's earning call, but China sales were way, way down for not just for electric vehicles, for any vehicles. China sales were way down. And speaking of China, the People's Bank of China injected, how much was it? About $80 billion via reverse repos into their bond market yesterday. PBOC is starting to turn on the fire hose of liquidity. Was not enough to stop Chinese stocks from going down again yesterday. Recall that story we talked about yesterday about how U.S. hedge funds were buying Chinese stocks hand over fist last week. Well, it looks like they're done. And without U.S. hedge funds buying stocks this week, those stocks have resumed their downward spiral, even though the PBOC is trying to flood the market with liquidity to try to help things out there. And it's just not really working. So much going on, so much to talk about, so little time. Why don't we just shrink my big melon of a head and let's get into these stories today. Guys, don't forget that like button. It really helps with the YouTube algorithm. And if you're new here, why not hit that subscribe button and that notification bell and have your coffee with the melon heads every morning as we go through markets. And the fear greed index is still in extreme greed territory, currently sitting at 78. We've been in extreme greed for a while now. The markets are definitely running on greed. Now, guys, I would add we have got a lot of announcements coming out in the next few hours. This afternoon, we've got Microsoft and Alphabet, aka Google, earnings coming out. I mean, a couple trillion in market cap right there. Tomorrow, MasterCard and Boeing, the Federal Reserve coming out. Thursday, Apple and Amazon. There's so much going on this week, and the market right now is at all-time high valuations, running on extreme greed. Everything needs to go right this week to keep this market moving higher. We'll see if they get it. But right now, the S&P is down 10 points ahead of the opening bell, about 0.21% down from their all-time highs as we start the day. The Dow is down 81 points, also 0.21% lower ahead of the opening bell. And the NASDAQ is down 42.9 points or 0.24% lower. So markets are down across the board, although very little bit, not a big move here. The dollar is a little bit weaker this morning, down 10 basis points at 103.51. Not making that big of a move in the dollar. And bond yields are lower, especially on the long end. The short end, not quite so much here. The 30-year Treasury yielding 4.288. That's down 4.7 basis points this morning. The 10-year, 4.05. That's down 4 basis points. The 2-year, 4.316, down about a half a point. The 1 month sitting pretty at 5.377, down a fraction of a point from the 5.38 yesterday. Now, I just want to show you guys the long-term trend of the 10-year Treasury yield here. Now, obviously, we were running up all last year. Everybody was screaming about the issuance and the oversupply. Then Bill Ackman covered his short, and the 10-year started flowing lower. The Powell pivot came in, and down we went all through the fall. Now, the start of the year, the 10-year Treasury yield started bouncing up here. You'll notice this red line that I drew here showing the rising support level. We broke through that one yesterday on the QRA announcement. So if we get another down day here, it could mean that this was just a dead cat bounce and treasuries are going to continue lowering, or we could see a recovery and we continue up along this line here. There's so many things that are happening this week between the Fed and the QRA and the big tech earnings. It's gonna make or break this chart. So, but we are kind of right at this support level here or just below it. See if we catch a bounce today. Looking over at the commodities board, April gold futures at $2,059. That's up about $14.75, 0.75% higher for gold. March silver futures at $23.34. That's up about a dime this morning or 0.42% higher. We've got platinum is down 0.5%. Palladium is up a little bit. And West Texas Intermediate crude oil futures for March are down 22 cents or about 0.25% lower at $76.59. Reverse repo watch. Let's take a look at this one. And we are currently at 581 billion in reverse repo. That's up 10.5 billion from the day before. Now, the interesting thing here, guys, we've been riding this trend for a long time, and now it's becoming increasingly clear that this trend is starting to flatten, especially since mid-December. Now, let's just draw this little line here. We can see here that we're starting to level off and that this chart is no longer falling the way it was here. So what's going on? Why is the liquidity being sucked into the market at a slightly lower rate? Remember, guys, the reverse repo falling as money leaves reverse repo, it's technically a liquidity injection and it's inflationary. But the reason that's happening is because the market needs that liquidity. So the market is less thirsty for liquidity all of a sudden over these last few weeks. What is going on here? Well, I think the answer is here in this chart. This is the Federal Reserve's balance sheet. Now, we only get weekly snapshots of this one. Every Wednesday, they let us know what it is. And this is going all the way back to April of 2022 when, quantitative tightening started and we came all the way down. Then there was the banking crisis last March and the BTFP was rolled out. Big jump in the Fed's balance sheet. QT continues. Now let's zoom in on just the last couple of weeks. And you can clearly see here, this chart, it was falling and now it is leveled off. The Fed has done virtually no quantitative tightening in the last few weeks here. What's going on? Well, the Fed is burning less money. That's really what's happening here. Now, this chart, this leveling off, this lack of quantitative tightening for the last month and a half. Also keep in mind that the bank term funding program is playing a role here as the BTFP rises, as companies chase the arbitrage opportunity. That's technically assets going on the Federal Reserve's balance sheet. So that's putting upward pressure on this chart. But that doesn't explain the complete lack of quantitative tightening over the last few weeks. QT is slowing. The Fed is slowing down the rate they're burning cash. Now, look for a lot of talk about quantitative tightening on Wednesday when the Fed does their FOMC press conference, which I will be live streaming as I always do. But it looks like they've already started to slow QT. It's showing up in the charts. They haven't told us about it yet. But the numbers don't lie, guys. The BTFP does not explain away all of this. Fed is burning money at a slower pace. Now, let's talk about the big one from Aunt Janet yesterday, who says our economy is strong and resilient, and I'm going to borrow less money this quarter because it's an election year and I really like my job. And if I can stay in my job for a few more years, then I can collect generous speaking fees for services rendered after I leave office. Well, the Treasury cuts quarterly borrowing estimate to $760 billion. The department released the borrowing estimate for January through March. And they're also predicting $202 billion in net borrowing for next quarter. The U.S. Treasury reduced its estimate for federal borrowing for the current quarter, a move unexpected by many dealers, helping stoke rallies in bonds and stocks on Monday. This was the driver in that big market rally yesterday. The Treasury Department said that it now estimates $760 billion in net borrowing for January through March, down from a previous prediction of $816 billion released in late October. U.S. debt managers kept their estimate for the Treasury's cash balance for the end of March at $750 billion. Now, that Treasury cash balance for the end of March at $750 billion, just want to point out, guys, this is the Treasury general account. This is Aunt Janet's checking account. It is currently at $799 billion. So they're saying they're going to spend down about $50 billion from Uncle Sam's Treasury account. Well, there is your reduction in the quarterly borrowing announcement there, guys. They were expecting 816 and they got 760, but they're going to spend 50 billion that they already have. So the government's not going to spend less money. They're just going to spend money they already borrowed. So this rally, yeah, it is going to result in less bond issuance, but it's not like suddenly there's a decline in government spending happening here. They're just pulling the money from a different pot. So I don't really get that rally. There's been no change to the insanity of spending in Washington. It just is what it is. And then there's this quote was pretty impressive here. Because of the enormous debts and deficits being accumulated, the Treasury's announcement on borrowing plans are now market-moving events. That's according to Peter Bachvar, the author of the Bach Report. The new borrowing estimate has the Treasury market rallying and stocks falling. So Aunt Janet really juiced the economy yesterday. Not the economy. She juiced the stock market and the bond market with her lower than expected borrowing estimate, even though all she's really doing, they're going to spend the same money. They're just going to spend money from the checking account in order to issue fewer bonds, in order to keep interest rates from rising, in order to keep asset prices at all-time highs heading into an election year. Now let's talk about UPS. UPS stock falls. Fourth quarter earnings and 2024 guidance come up short. And I'm sure this is just a wonderful sign for the economy. Maybe this is artificial intelligence is causing this, and really this is just a great thing. I don't know. I'm just trying to explain it away here, guys. But UPS stock is dropping after the shipping giant posted weaker than expected operating profit. The initial outlook for 2024 isn't helping either. UPS reported a fourth quarter operating profit of $2.5 billion and earnings per share of $2.47 from sales of $24.9 billion on Tuesday. That is way down from last year's numbers, which I won't get totally into last year's numbers here. But here's the important thing in this earnings release. Weaker volumes from a slowing economy are partly responsible. Emphasis, partly responsible. That doesn't explain away such a big drop in their profits. By the way, UPS profits were down 22.5% year over year. That's what their profits were down. Now, their revenues were only down 7.8%. So UPS margins are getting squeezed. Why are UPS margins getting squeezed? Because of the labor contracts and the reduced volume. They're spending more money on their labor. Remember the strike from last year? Well, they wrote in a very big wage increase for their employees who are demanding it, justifiably so, because of the rate of inflation and what the cost of living has done. Well, that's eating into UPS's earnings, and UPS does not have the pricing power to just raise costs and pass that on to the consumer. They're doing less business here. So some businesses left the UPS network to avoid being caught up in the potential work stoppage. So FedEx may have captured some market share there, but volumes in the U.S. dropped 7.4% year over year in the fourth quarter, and international volumes dropped 8.3%. Those are damning numbers right there, guys. A big drop like that in package volume, you can't hide that with creative accounting. You can't hide that with stock buybacks or underreporting inflation. At the end of the day, there are fewer boxes going onto planes and trucks and being delivered to people's homes, and that is killing UPS. This morning, UPS stock, let's see, is down 5.78%. It was down a little bit more. It was down 7.5% at one point this morning. So it's clawed back some of those losses, but UPS is not having a good day. Now let's talk about General Motors on the other hand, because General Motors, well, they are having a good day. I don't quite see what's driving this good day for GM, but let's talk about it. GM beats Wall Street estimates and forecasts continued strong profit in 2024. Got to stop right there because their profits, they beat their top and bottom line expectations, which were artificially lowered. Their profits were not that good. I guess their guidance was pretty good, and maybe that's why the stock is rallying. But most of the numbers I'm seeing in GM's earnings reports and most of the comments from their executives are actually pretty alarming. General Motors beat Wall Street's top and bottom line expectations for the fourth quarter while forecasting another strong year despite potential economic sales headwinds. Check this out. China, GM's second largest market, continued to struggle with a 34% decline in equity income for the year, including a 54% drop during the fourth quarter. Whoa, 54% drop in income for GM in China in just the fourth quarter. Things in China are worse than they're telling us, guys, and they're telling us things are pretty bad. So apparently they're even worse than that. People just ain't buying cars right now. Now, what else we have? GM expects to spend roughly $1 billion less this year on their majority-owned autonomous vehicle subsidiary, Cruise. All right, so that $1 billion less spending on autonomous vehicles, which are yet to yield any income for the company. Maybe that's why their guidance is so strong, because they're going to spend less on CapEx. That's certainly a possibility. Now, there was a couple of things here. Look at these regional results. And how are they beating expectations with regional results like this? GM's North American adjusted earnings were off 45% during the fourth quarter from a year earlier to $2.01 billion. Wait, their earnings were down 45% versus a year earlier? Then how is this a beat? How are they beating on the top and bottom lines? How are they reporting another strong profitability if their North American earnings are off 45%? And what? Okay, China, GM's second largest market, continued to struggle. A 54% drop during the fourth quarter. So, all right, GM's posting super strong numbers. They're not coming from North America. They're not coming from China. So Europe, I doubt it. Africa, South America, who's buying cars? Why are these earnings so strong? Okay, that was the CNBC article. I'm looking for good news here. Let's see what Wall Street Journal has to say. GM's fourth quarter profit dinged by the strike and the EV losses, but company sees a potential for profit rebound this year despite easing prices. Okay, so they see potential. Maybe that's why the stock is rallying. Oh, easing prices, that's not good. Where are the good numbers here? GM is projecting potentially stronger profits this year as it expects to narrow losses on electric vehicles and driverless cars and rebounds from a factory strike that marred its bottom line in the fourth quarter. Okay, I guess that's not terrible. Here we go. This is, according to some guy named Jacobson, there must be referring to him in a note earlier in the article. He says the bottom line on GM's EV business will improve this year as the company scales factory work and introduces new models, including a battery-powered version of its hulking Cadillac Escalade SUV. And it was at this point that I almost broke my glasses because I face-palmed so hard. Who in their right mind, what kind of idiot, narcissistic, self-centered, I am helping flag in their profile idiot is going to buy an electric Cadillac Escalade? The Escalade is synonymous of these grotesque, gas-guzzling, giant, heavy, pointlessly large pig vehicles. Oh, but it's electric, so I'm helping the environment. And the fact that they think there's a market for this garbage just tells you how stupid corporate America thinks the average consumer is. An electric Cadillac Escalade SUV. I couldn't believe what I was reading. And they're talking about how, yeah, they think that will cause their results to improve this year because because some soccer mom driving herself to yoga class in a 50,000-pound electric SUV because it's good for the environment is going to save GM's earnings. Gotta love this stuff. You can't make this stuff up. What we don't want to do is get into a position where we're focused on ramping up production that we're not thinking about where the consumer is. In other words, they're saying we're done just vying for subsidies from Uncle Sam, and now we're going to build factories that make cars that we think people want. And somehow that includes an electric Cadillac Escalade, but okay. But so far, when you look across our models, we feel good at the way we're being received. So somewhere in all that was really good news because General Motors stock 7.25% higher ahead of the opening bell. Again, I don't really see it. I guess it was that stronger than expected guidance is driving it, but that guidance seemed like it was a little wishy-washy. And it's really being driven mostly by General Motors saying we're going to waste less money on electric vehicles and driverless cars. And by the way, spending less money on driverless cars, isn't that something else that's probably a little bit AI bubbly? As if driverless cars was one of these big facets of artificial intelligence that was going to drive the demand for artificial intelligence, why is GM scaling back by $1 billion their investment in driverless cars? Again, where is the revenue from artificial intelligence? Where is the actual company making money other than the companies that are talking about how much money they're going to make actually making money? Are any end users of artificial intelligence actually profitable yet? I don't know. I don't think so. I haven't seen one. Meanwhile, speaking of cars being down in China and slowing car sales in China, check this one out. China's central bank, this is in Xinhua News English, China's central bank adds liquidity via reverse repos. China's central bank conducted 563 billion yuan, that's about $80 billion US, of 7-day reverse repos at an interest rate of 1.8% on Tuesday. How'd you like to be able to borrow 80 billion bucks at 1.8%? Man, that sounds good. Sign me up for that one. The move aims to keep liquidity in the banking system stable at the end of the month, the People's Bank of China said in a statement. Now, this is an important thing here. A reverse repo in China is a process in which the central bank purchases securities from commercial banks through bidding with an agreement to sell them back in the future. So a reverse repo in China is the opposite of a reverse repo here in the States. A reverse repo in the States, you park cash at the Federal Reserve and they lend you a asset like a bond. A reverse repo in China, you park a bond at the PBOC and they lend you money against it. So this is China injecting liquidity, putting money, printing money into the market to try to suppress interest rates. So China's fire hose of liquidity is open. They are supporting their markets with all this other stimmy stuff we talked about in the last few weeks. That's all still going on. but now they're actually just outright injecting cash. But it was not enough to save stocks yesterday. This is the Hang Seng Index in Hong Kong. That was down 373 points yesterday. Let's zoom in a little bit. There's that red candle right there, down 2.3% yesterday. Now, this highlighted area looks like the shape of a cotter pin there. That is U.S. hedge funds last week buying Chinese stocks, trying to catch a falling knife and nail the bottom. And, well, this week, China stocks have started falling again, down 2.3% yesterday. And the SSE, or the Shanghai Stock Exchange, the SSE Composite, that one was also down 1.83% yesterday. Again, 2 red days in a row. China stocks have resumed their fall after a dead cat bounce yesterday. And I just want to say thank you ever so much to Mr. Easy Fix. Thank you, sir, for the super chat, the support of the channel. Easy Fix says, fun fact, banks now offer BNPL on your debit transactions, interest-free. Chase offered me this option on my utility bill. Say what? Everything's okay, right? Oh, man. People paying utility bills with buy now, pay later. And listen, Easy Fix, again, check out that video I did on BNPL loans last week. Here's the thing. The banks that are doing this, and maybe the banks have better access to data than Walmart's checkout register has, when you scan your item and they offer you BNPL. But the banks are not planning on taking this risk. They are going to sell this risk, much like with Affirm and everything that I saw and talked about in that video. Cross River Bank is rubber stamping loans to people with garbage credit scores. They're not looking at anything. They're claiming they have this big proprietary data-driven algorithm that gauges risk. That's the same BS they told us when they were rubber stamping PPP loans to fraudsters during COVID. They don't. They just collect the fee and they approve everyone. Well, what they do is they take those loans, they immediately sell them to somebody else, and at the end of the day, they wind up in people's retirement accounts. And now they're offering that for utility bills. Good God. Good God. What a mess. It is debt fueled. Debt is keeping this plane out of a stall. Debt, we're pushing a car up the hill with new debt, and the second we stop pushing, that car starts rolling back down the hill. Thank you, Easy Fix, for that data point. Incredible that they're offering you BNPL on utility bills now. What's the worst thing that could happen? I'm sure that ends well. And it's really a strength. That's a strong indicator about the health of the U.S. consumer, right? That he needs a BNPL loan to pay his electric bill to keep the heat on in the wintertime. Good God. Thanks again, Easy Fix, for the super chat, sir. And thank you, JJ Watt, who says, your video with real estate mindset gave me the chills. Keep up the great content, NSF. Thank you very much, JJ. I appreciate that. That was unexpected, that video that I did with Travis at Real Estate Mindset. We sat down and we meant to talk about cash out refis that we saw. I had seen the spike in refinances. This was about 2 weeks ago. We filmed the video and refis had just jumped by about 11%. So we sat down to talk about refis and what we think might be happening there. And, it went into this very deeply personal story that Travis and everything he went through during the GFC and his self-sabotage and his spending habits and everything he had to go through to dig himself out of that debt trap. And he had the mortgage company came after him, the IRS came after him. It was a nightmare. And it was really unexpected. And a lot of really good comments on that video. People responded really well to that. I think a lot of people identified with that because there's probably more people out there who have gone through that than we realize. And yeah, that was, I remember while we were filming that saying, wow, this is deep, thinking to myself. And, shout out to Travis for sharing that story. I think a lot of people are going to benefit from hearing that. And hopefully people learn the lessons from his mistakes and don't repeat them. So thanks again, Travis, from Real Estate Mindset. I appreciate that, brother. And thank you, JJ Watt, for the super chat, sir. Appreciate the support of the channel. And Vegas Schmitty says, in debt-driven economy, people's ability to borrow caving, banks hesitant to lend, rich people using cash. Where does the debt come from to fuel the economy? The debt comes from you, Vegas Schmitty, unfortunately. It comes from your retirement account. Every story I've done for the last year about some garbage commercial real estate debt, about buy now, pay later loans, about risky mortgages issued by First Republic Bank, all right, about bailout. Ultimately, at the end of the day, the ultimate dumping ground for all of this garbage debt is middle-class retirements. And that is what's fueling this. All the people who are mindlessly pumping their money into retirement accounts and their financial advisors are collecting fees, putting them into this garbage debt, these CMBS, these securitized BNPL loans. And even these financial advisors, they're not digging deep into what is in these funds. They're just saying, okay, an income ETF, it's run by a reputable industry. They pay me commissions in order to sell these things. So I will put my clients into these income ETFs because bonds are viewed as low risk. You actually open up the prospectus on these income ETFs and you see a line of text, something that says like B-Way 2015-1740 Mortgage Trust. Okay, what does that mean? You don't realize that is the debt on a building that hasn't seen a payment made in 2 years that the lender won't even foreclose on because they don't want the maintenance and the tax bills. And at the end of the day, that building is a hot potato. Nobody wants to be left holding when the music stops. And where is it sitting? In people's retirements? The source of the debt, Vegas Schmitty, is us. That's what's such a joke. It's either our retirements or our future earnings in the form of government debts, future tax dollars, or future inflation caused by the Federal Reserve monetizing the debt. It is us. We are paying for this. And that's why I get I grind my teeth. My molars, they're almost gone. Every time I do one of these stories, I just can't believe it. How are they hiding this stuff in pensions? Okay, there it is. There's the mechanism where they get this stuff into people's retirements. Every single time, Schmitty, that's where I find this debt is coming from. And thank you again, sir, for the super chat. Thank you, Diego Pasher. I hope I said that right, Diego. He says, yo, melon cabeza de melon. See, I think deliveries are down because there is nothing cool to buy. Think about Apple, no enticing products. I struggle with Christmas gifts. Did you struggle? Was it financially struggled or struggle because there was nothing cool to buy? Because, hey, all you people out there who want to go into debt buying pointless cool stuff, the Apple Vision Pro at $3,500, I mean, you can spend money on this giant set of goggles, which does some cool stuff. It does look pretty neat, but at the end of the day, it's this big cumbersome thing that's probably not going to work in 5 years, and it's probably going to give you neck pain because of the weight it's putting at the front of your face. Not to mention it's another thing standing between you and the other people in the room. So God forbid we actually have any legitimate person-to-person social interaction, says the guy on social media, by the way. Little irony there. But there's plenty of cool stuff out there to buy. I mean, look, at the end of the day, if people want to waste their money, the market will provide ways for people to waste their money, and they'll provide innovative ways for people to screw their future selves in order to get that stuff now, just so they could juice their temporary earnings. So, we're going to hear, we get Apple earnings. What is that, later today or tomorrow? When is Apple reporting? Apple is Thursday after the bell. We're going to find out what they think, how well received that Apple Vision Pro is, how many people are still buying iPhones. I have heard bad things about iPhone in China and lowering prices in China. So I'm a little worried about Apple's earnings, but I'm already starting to see this narrative that the Apple Vision Pro is going to drive all these sales at a $3,500 price tag. I just can't imagine that's going to happen, but we'll see what Apple says in their earnings on Thursday. Thank you, Diego. Appreciate the super chat, sir. And thank you, Steve Woitis says, regarding government debt, if I went to the bank to take out a loan from your account, I would go to jail. Why are we okay with the government doing the same thing to us? That is a fantastic question, Steve Woitis. And much like, say, Ponzi schemes, if I were to run a Ponzi scheme, I would go to jail. And yet Social Security, which is exactly a Ponzi scheme, does the same thing. Right? They claim it's a trust fund and that they invest your money and it'll be there when you retire. They don't invest your money. They take it and they give it to the people who they previously promised it to. It is by definition a Ponzi scheme. Well, the government has a monopoly on violence, or at least mostly they do. And so they just do what they want. They follow the laws they want to follow. They ignore the others they want to ignore. They do whatever they want. And then they have the press to fly cover for them that will just tell people whatever they want the government to say. The press used to be the watchdog of these crooks. Now they are the mouthpiece. Maybe that's why Twitter is now the #2 source of news in the world. I saw that one yesterday. Fidelity increased their value of their stake in X, formerly Twitter, by 11% because they're saying Twitter is the second busiest news site in the world. Why? Because the mainstream media doesn't control it as much as they tried. They tried to punish Elon for not censoring, and well, Elon said, go F yourselves, and looks like it's going to work anyway because Fidelity is increasing their valuation. So, I got a little tangential there, but yeah, what the government does with debt, anybody else does that, it would be illegal. The government does what they want. It's not supposed to work that way, Steve. Thank you, sir, for the super chat. And Nashville Pasta Man says, I always park my Escalade in the EV spot at Whole Foods. I have that Dennis Leary song because I'm an a-hole playing in my head as I say this. I park my Escalade in the EV spot at Whole Foods. I tell them it's a hybrid. Hey, I'm subsidizing the charging stations. Thank you, Nashville Pasta Man, for doing your part to subsidize charging stations. Thank you for the laugh, sir. I got a kick out of that one. It's a hybrid. I'm helping the economy. Thank you, everybody, for having thank you to Nashville for the super chat, sir. Thank you, everybody, for having your coffee with the Melonheads this morning. Also, thank you to my Patreon supporters for everything you guys do for the channel. Link down below to all that good stuff. Hi, Mom. Hi, Dad. I love you guys. Until next time, live small and dream big.